tuning in. It's really, really important that I date stamp this recording as being the 17th of November 2022, a couple of hours after the government mini budget, and it will become apparent why. And it's meant that I've had to rapidly change some of my slides. So the event is aimed at clarifying care funding. I've again had to change the agenda slightly, but what I thought we'll do over the next sort of 45 minutes or so is have a look at exactly how the care system works now from a funding perspective. I think that slide visualises quite well how people feel when they're dealing with this for the first time. Certainly, that's how my family felt when we dealt with this for a relative. So we'll clarify exactly how the system works currently. And my first slide change is how the system is changing, but when it might be changing. We'll also have a look around the family home, whether a property has to be sold to pay for somebody's care. And then we'll wrap it up really with looking at whether there are ways to limit the amount of money that might have to be spent on funding a care home place. So hopefully that's going to cover what you were looking for from the event. If it isn't, if you have burning questions that don't get answered through the next sort of 40-45 minutes, then our website, eldercaregroup.co.uk, does have a contact form. It has our phone number and email address on there, which I'll also display at the end. So do feel free to just come back with your specific questions if they're not answered. Just before I start working through that agenda, let me just give you, I suppose, a more polite, formal introduction to ourselves so you know why we're qualified, if you like, to talk about any of this. And that is to say that we are a firm of IFAs, Independent Financial Advisors, but we're all accredited by the Society of Later Life Advisors. So if you like, externally audited to show that we do specialise in this field and we do have knowledge that perhaps a general holistic IFA might not have. Even within SOLLA members, I would say that we're a fairly rare breed in that we only advise on solutions for care fees funding. So whilst we do have qualifications around mortgages and pensions and that type of thing, that's not what we do every day, so we're not experts. This, on the other hand, is all we do every day. So we do regard ourselves as experts. And we've been doing it a long time. Eldercare is actually my company, set up in its current format in 2007. And that, as I alluded to, was because my family went on this journey with my grandparents and we got no advice at all. And that's not to point the finger at anybody. It's an absolute classic case of you don't know what you don't know. We thought we knew everything. We thought we just sold the property, used the money and approached, you know, the council for funding when the money ran out. So when I found out other options later on in my career, that's why I set the business up, got on the soapbox and kind of haven't got off since. So we're not linked to any particular care provider. We work up and down the UK with many, but there are no sort of untoward things going on behind the scenes. It's just about getting good information to those that need it. We are having money conversations with families often, and it's important when that happens that the advisor is regulated by the Financial Conduct Authority, and you will find us listed, of course, on their register. And yes, I'm based in Hertfordshire, but even pre-pandemic, we delivered our advice, generally speaking, remotely, unless that was not practical to do so. That might be telephone, that might be an email, that might be a written report posted, more latterly Zoom and FaceTime, etc. But the reason we did that was because often the family were in different parts of the country. It was hard to get everybody together, and we didn't want things to get lost in translation. If I say something to one family member and they mention it to another family member, it's almost that things get watered down. So we just want to make sure this really important advice is delivered in the most compliant way. And because we aren't spending lots of time on the motorway or you know, evenings out around people's houses, because we're not doing all of that, we don't have to charge for our time in that context. So any consultation that you have with us over the phone, email, etc., even the research of some of the financial solutions we'll look at, that's done at our expense, not yours, because of that business model. So I hope that makes sense. So looking just really then back to the agenda and the cost of care and who pays for it, how does it work currently? If I keep it really simple, and it isn't as simple as this, but in the time constraints I have, 3 funding streams is what I would break it down into. You are either paid for by the local authority, social services, the council, it's fundamentally the same place. You might be funded by our much loved National Health Service. Alternatively, you are deemed to be a self-funder or a private fee payer. That's the sort of language that sits around those 3 funding streams. So if we take them one by one, that I suppose to some extent the most complicated is the local authority funding stream. And often people think that access to funding from the local authority all sort of hinges on whether or not you've got a certain amount of money. And that's true to some extent, but the entry point to any local authority funding is actually the person's care needs. So you would ask to be assessed by a social worker, adult social care, if you think you need support, and they are supposed to look at your care needs first and foremost, and whether or not you meet their eligibility criteria, and this can vary from council to council. So if somebody just, if you like, wants to go into care because they feel they would be better supported there, but the local authority don't think they need to go into care, they're not poorly enough, the conversations kind of stop there. So it's a care needs assessment that happens first, and only when that's been done is the money conversation supposed to take place. And that money conversation, the financial assessment, is more commonly called a means test. So that's the theoretical order of events. We know in reality often they ask questions about the money first, which is not correct. So what are they looking for when we do the financial, or they do the financial assessment? Pretty sure, even if you're new to the journey, that you would recognise this figure. It is to ascertain whether you have above or below £23,250 of capital. That's in England, Northern Ireland. People talk about Scotland as being free or generous. The capital limit in Scotland is only about £5,000 more than it is in England. The limit is actually far more generous in Wales, where it's £50,000 with no lower limit. And these figures are per person, so double them for obviously for a couple. Now, there was a bullet point that went on here to say what the capital threshold was going to be changing to next October, in fact, but as part of the budget statement, that's not going to be happening for at least 2 years. So I've removed it from this particular slide. Suffice to say, for at least the next, well, nearly 3 years, the entry point, unless we hear otherwise, for any state support will remain at £23,250. What is deemed capital? Is it everything you have? Well, pretty much everything you have is indeed capital as far as the means test is concerned. But there are 3 exceptions that I just want to quickly draw your attention to in case they apply. The first is if we are talking about a couple. In that instance, it's only the person going into care whose capital is assessed. So the person staying at home, 100% of their solely owned capital is not mentioned or shouldn't be mentioned in the means test. Anything that's owned jointly, joint accounts, joint investments, 50% only should be included in the person's means test. But there is an argument, if you have joint savings accounts, for example, the person staying at home should move their 50% out of a joint account and put it into their solely owned name, just to keep it crystal clear who owns what and to avoid anybody having their money taken into account when it shouldn't be. As long as you don't mess with the percentages, that's totally legitimate and advisable even. The second exemption, which affects most people, I think, or more people, but still seems to be a concern, is that the property, the family home typically, it's not included in the means test at any point, not retrospectively, at no point is it included if the spouse or a relative over 60 lives in it. That relative over 60 rule, there's a couple of other exceptions as well, applies if it's a genuine living arrangement. So if the 62-year-old daughter moves in the day before mum moves out into a care home, of course that won't apply. But if it's a cohabiting arrangement, relative over 60 lives there, spouse lives there, property can't be included. Now, if the spouse moves into care themselves from that date forward, of course the house forms part of both their means tests. If the spouse at home predeceases the spouse in care from the date of death, it forms part of the means test. But otherwise, we hear families say, oh, will they come back and get the money later? No, the property is invisible for the time that the spouse or relative over 60 lives there. Okay, so please be clear on that. Investment bonds is the third exception I wanted to mention. It affects less people, but lots still have these. Typically, you'd have an investment bond if you had taken advice from an IFA. These have to be recommended through a professional. You can't normally just go and buy them off the shelf, and they're distinctly different from the 1, 2, 3 year deposit bonds that you might take out with the bank or building society. So if they include life assurance, and we can spot this quite easily from sight of policy documents, those bonds, that particular type of bond, is not included in the means test. Absolutely, you can cash it in and use the money, but you're not under any obligation to do so. Now, that's capital. Pretty much everything else, holiday homes, business assets, money under the bed, premium bonds, stocks, shares, all those are included in the means test. But we must not, we focus so much on capital and is it above or below the threshold, we mustn't forget about income, because that counts as well. So the exception here is if we have a couple, then the private pension only of the person going into care, they can carry on paying up to 50% of that to the spouse at home. So that isn't included. But otherwise, when the local authority agrees to pay for somebody because they are poorly enough, they meet the eligibility criteria, they have under the capital limit, even in that scenario, the local authorities will to some extent limit what they're going to pay. Now, they can't just say, we have a maximum in this area of £500 a week. There has to be at least one care home place offered to that person that meets their needs, that the local authority will pay for, and that nobody else has to pay a top up for. There must be at least one genuine option, because not everybody has somebody that could pay a top up. So it may well be that that care home place, does only cost the local authority £500 or £600, but if there were no homes prepared to take that, the local authority would have to pay a little more. So that's the first thing to note. But when talking about income, the local authority, when they say what they'll pay, they still expect the individual to contribute their income towards it. So if the local authority say there's a care home place over here, it costs us £600 a week, you can't then add your pension on top of that. If there's a £200 a week state pension, you have to give that, all bar £25 of it, you have to give that to the local authority, and that in effect reduces what they have to pay by £400. So it's a combined contribution that we're looking at here, not I get this from the council and we can add the pension on top. The pension just goes towards what the council would pay. So in some extreme circumstances, if someone has a very, very good pension, a high private pension, they're not paying it to a spouse, they're widowed, that pension could be more than the local authority would actually pay for them. So on the face of it, they get state funding, but when the contributions are worked out, they don't get anything. That's unusual, but can happen. So income counts as well. And when we're looking at local authority funding, there's really only sort of 2 occasions where a third party top up can be requested by the care home. And that would be in that example I gave you of the care home finding and funding a place. If the individual or the family doesn't like it, they want somewhere else that's perhaps nearer or got better facilities, or for whatever reason, they choose somewhere more expensive. In that instance, of course, the care home can ask for a third party top up. You can't be your own top up. Or the scenario where somebody starts off paying for themselves, they run out of money, they ask for the local authority to pay for them, but the local authority aren't going to cover the fees at that home could ask the difference to be made up by a third party. Now that, does that happen all the time? It depends. It depends how long into the care journey, how long that person's been living at that home, what was said when they took the care home place, what's written into the contract, what understanding was there around this issue. Ideally, the care home and the council come to sort of a halfway house and negotiate between them. But you must be aware that in certain instances, the care home might request a top-up. So that's our sort of local authority means tested social care funding system. And that's not going anywhere. And there were going to be some changes, as I say, to the entry point, but those have been kicked down the road. But just need to be clear on that system. The care cap, which has been being talked about actually for at least 12 years, because there was a care cap that was due to be brought in and announced in 2014. We're in a similar place now where a care cap system has been talked about, and we were expecting it to be coming into force next October 2023, but the mini budget a couple of hours ago confirmed that as they refer to it, the DILNOT changes, and as I say, that reflects back to the care cap changes of old. Those changes have been kicked down the road till October 2025, and I leave the question mark there because once we start down this path, last time we had deferrals, it did end up in a complete and utter U-turn. So until we get to October 25 happening, I'm going to leave the question mark there. But I think it's important you understand what the care cap was all about, in the hope that you'll realise being pushed out to 2025 isn't actually going to make a material difference to you or your loved ones, because it wasn't quite as it seemed anyway. So what I can tell you about the system is that it was never going to be retrospective. So whenever it happens, money spent on care prior to that date won't count towards the cap. And it was always intended to be in addition to the means tested system. So I heard sort of some loose terminology that, that this replaces the means tested system. It doesn't. It's going to be two systems running in parallel if and when it ever happens. And what's really important for yourselves to know at this stage now, the monetary amount might change by the time we get to October 25, but it was supposed to be an £86,000 cap. But to most people, that sounded like, oh, well, if I'm in a care home costing £1,000 a week, it will take 86 weeks to reach the cap. That was kind of the understanding. The reality is that only personal care costs were ever going to count towards the cap. And this is the bit, at a rate or the rate set by the local authority, not what the person is actually spending on their care. So if the local authority only pays £600, but someone's in a care home self-funding at £1,300, the top-up costs, which are significant in that scenario, those £700 a week top-up costs won't count towards the cap. And I genuinely don't think people realise that. I think they thought what they spent on care, the actual invoice, the money going out of their bank account, that would be monitored. And when they'd spent 86,000, they wouldn't have to spend any more. I'll show you a worked example. It's so far from the reality. What they also said was that some of what you're spending on care isn't actually for care. It's for hotel costs, daily living costs, and they were going to deem those to be a flat £200 a week wherever you were in the country. So care homes didn't have to itemise the bill. They didn't have to split out what was for food, what was for lodging, what was for care. It's a straight £200 a week assumed for hotel costs. So let me give you the worked example. As I say, the aim of this is to maybe make you feel a bit better about the delay, that it wasn't maybe going to benefit you that much anyway. I use this example, these figures just now, because they are national averages. You know, £1,300 a week for a self-funding decent home is not unrealistic, and it's neither unrealistic that the local authority would pay only £600 a week for that person if they were funding them. And this is the problem. There's a huge disparity between what the council pays for someone's care and what a private fee payer pays. The private fee payer gets choice, of course, but the financial gap is really the root of the problem here, because, as I say, I might be able to evidence an invoice that my mum is paying £1,300 a week, but on the care cap computer account running at the local authority HQ, they're only going to clock up £400 a week towards my mum's care cap. They'll say that £600, that's what we pay for people, so it's £600 is the care cost minus hotel costs of £200. So as I say, even though I can show that we're paying £1,300 a week, the clock is only going to tick up at £400 a week, which means it takes 4 years, roughly, from whenever the care cap comes in, now allegedly 2025, 4 years from then, so we're now approaching 2029, before the cap is reached. And yet, during that time, my mum in this example has actually spent closer to £280,000. That's not an 86,000 cap on care costs. Even when she reaches the cap, now towards the end of 2029, if she still has money, if she's still a self-funder, she still has to pay the hotel costs and she still has to pay the top-up costs, i.e. the majority. All that will happen is the amount that was clocking up on her account, the £400 a week, she'll now get that as cash in the bank. Great, she'll be very grateful, but she's still having to cover the majority of the costs herself. So it's really upsetting that this has been kicked down the road again, but actually, even if it had come in as planned next year, the majority of people with assets, self-funding, are still going to have to cover the bulk of the costs themselves. So sorry to impart that news, and as I say, hot off the press, it's been delayed, but it's important, I think, that you understand the reality of it in any case. Second funding stream, the NHS. Now, this is a system that currently exists. It's not going anywhere. It hasn't been postponed. It is current, but it's very difficult funding to access. This is for people who have healthcare needs. They're more likely to have the sort of conditions that are looked after perhaps in hospital, where you do get it funded by the NHS. Just because you're in a care home setting, the NHS should still be paying for you. It might be that they'll only pay for a bit of your care. If you need some sort of medical intervention, they might pay funded nursing care. But if you're very poorly with complex, unpredictable, unstable health needs, the NHS should be funding it. And in that scenario, it is not means tested. It's not related to your money, it's related to your health. So we're not experts in this, but we do know people that are ex-nurses that can do assessments to see what likelihood there is of you or your loved one qualifying for this type of support. But it's something that might not feature now, but could feature further down the care journey. So that's why it's getting a mention here. But otherwise, if you're not eligible for means tested funding because you have too much money, you're not eligible for that NHS funding because you're not poorly enough, that's what puts you into this self-funding, private fee paying category. So it's a lot of people, particularly when you consider you only have to have above 23,000 to be in that category. So the only sort of state benefit as such that would generally apply to a self-funder is the attendance allowance. The figures up there are the day rate or the day and night rate. And if you're not familiar with this, do get in touch because we can give you the phone number to make a claim and explain to you how it works. It's a non-means tested state benefit paid tax-free. People think it stops when you move into a care home. It only stops if you're state funded because it's just interdepartmental then. But if you're paying for the care yourself, moving into a home, you can still have this. Indeed, it may go from the lower rate to the higher rate because you've moved into care. So really, really important people are claiming this. The number of people that don't know about it remains shocking. Otherwise, for self-funders, in terms of state support, what's available, the only other support normally sits around if you're a property owner, but also a property owner with less than the 23,250 capital, because what the government has to do, or sorry, the local authority has to do, if that house is being left vacant, so not the example with the spouse living there, but it's being left empty, the local authority has to ignore it. ignore its value for the first 12 weeks of a permanent move into care. If by ignoring the value, the other money is under the threshold, it means the local authority has to pay for the person for those 12 weeks, not lend them money, pay for them. The caveats being you've got to meet the eligibility criteria, so you've got to be poorly enough in their eyes to have to go into care. You still have to contribute your income towards that, what they'll pay, and they will only pay at their sort of local authority assessed rate. So it might not be enough to cover the fees at your chosen home if you're a self-funder, which you are if we're talking about owning a house. So in that instance, the care home may very well ask for a top-up during that 12-week period. That can be paid from I said earlier that you can't have first-party top-ups, it has to be someone else. Purely in this scenario where it is a self-funder, just getting some short-term support from the council, you can be your own top-up. So you could use your remaining £20,000 to be your own top-up. Does the property have to be sold? Well, that was the whole point of this 12-week breathing space. It was so that the individual or the family, the attorneys, could decide. Because actually they might think renting it out is a better option than selling it. And so many families think, but I can't rent it out because the rent plus the pension plus the attendance allowance, that's still not enough to cover the fees. We're going to have to sell. Pause. You don't necessarily have to. You can't get equity release. You can't borrow money from a mortgage company in this specific scenario because you have to be an owner-occupier or have arranged the loan before you move out to get an equity release. But by any other name, you could go to the local authority and get an equity release, aka deferred payment agreement from them. So there's pros and cons, there's things to think about here. Of course there is. I'd recommend we have a holistic chat, but you just need to know that this is an option that all local authorities have to have a loan scheme available for their citizens. They can charge a setting up fee, they can charge interest, which the rate is no doubt going to go up very soon. You still have to meet their eligibility criteria and your other funds have to be under the threshold. But as long as there's no other mortgage on the property, there's no charge on it, and as long as there's typically enough equity to cover any loan for 2.5 years, they should make the loan available to you. And the good news here is they can cover full fees. They don't have to restrict the loan to that sort of £600 a week local authority rate. So for some people, this can work really, really well. It is a follow-on from the 12-week disregard. So you don't have to pay that 12-week funding back, but from week 13 onwards, that would become a debt. It can be used just for the short term if there's a cash flow issue, or it can be used long term until the person dies so that there can be a tenant in there generating some extra income. So just be aware of it. Apologies if it doesn't affect you, but it does seem to apply to a lot of people. A lot of people have a property and not much in the way of savings, so this can be very valuable. Otherwise, really our self-funders, if we now look at them in a more broad context, perhaps somebody that's already sold the house or who's got investments, etc. When we talk to families, our job here at Eldercare, as I say, is just to chat to families about the system, how it works, what options they have for paying for care. The two main concerns, almost the two only concerns they share with us on the funding side of things, is cash flow forecasting. How do we know whether we can afford this home for mum or dad if we don't have a crystal ball and we don't know how long they'll be there? It's a very valid question. And what happens if they do outlive their capital? That's also a very valid question. Now, if we talk to a family, and even if we sort of factor in income, we work out that they've only got enough to pay the fees for a year or 2 years. There's, with the best will in the world, nothing really we can do to prevent that money running out in the event mum or dad lives for that period of time. All we can do is tell them when best to approach social services, to have an open and honest conversation with the care home about when this is likely to happen and whether the care home's agreeable to moving them across to a state contract at that point. However, if they have upwards of maybe 3 years worth of funding and they're worried about the money running out or what's going to happen in the future, there is a solution that 85% of those people for whom it could work 85% of them will never get to hear about it. Now, I think that is such a shocking statistic. It's why I do what I do. I'm not here to tell you that this solution is for you and you must have one. I'm here just to make sure that you know about it and that you can, as a family or as an individual, make an informed decision rather than doing what we did as a family, just trotting down the default option of selling and pay as you go. So there's nothing wrong with pay as you go, as long as you accept that even with good investment advice, and you generally get risk associated with good returns when it comes to investment. That's the sort of normal rule of thumb. Even with good advice, most people can see a point at which that money could run out. So it doesn't provide certainty. It might look good in the short term, that there's still, you know, a big sum of money in the estate, but as it dwindles every year, families do lose sleep over that. So this is an alternative to pay as you go, rather than just pay as you go default. Decide whether this does or doesn't offer a viable alternative to you. What am I talking about? Well, it's basically a way of capping costs yourself. And as I say, only 15% of self-funders ever get to even hear about this. It is a type of insurance. And I suppose with insurance, we're sort of hardwired to think that you have to buy that before you need it. So you certainly have to buy your car insurance before you have a crash. But with care home fee insurance, you can't do it ahead of time. You can no longer buy it in advance. You can only buy it at the time that you move into care or the time that you employ a carer at home, i.e. you have a care bill to pay, or you can buy it after you've moved into care, perhaps once the house is sold. You just can't buy it in advance. The Google search engine term, the sort of technical product name, is a care fees annuity. But often when we say the word annuity, you know, John down the pub will tell you it's really poor value. But John down the pub might be thinking about a retirement annuity or a pension annuity. So they're similar. They're similar in that you're swapping a lump sum, giving it to an insurance company, a one-off payment, never seeing the money again, other than in the form of an income for life, which is guaranteed. But with a retirement annuity, of course, the insurance company is looking at that client thinking, well, they're age 60, they might need this money for 30 years. They want their spouse to get a widow's pension. They want indexation built in. You know, what looks like a big lump sum of money ends up converting to quite a low income. So that's, in my opinion, where the bad press comes from. But with a care fees annuity, the average customer age at ours is 89. My oldest client was 103, purchased one of these. So, of course, then the insurance company isn't anticipating paying out for 30 years. You can't have a widow's pension built in, so there's no extra commitment there. So in other words, the lump sum that you need to spend to get a particular income is a much, much smaller lump sum. It's still a significant amount because we're talking about people often needing an extra 30, 40, 50,000 pounds a year. So if you need a big income, you know, the lump sum is still going to be quite high, but nowhere near the sorts of sums that we're talking about for pensions. It's different in that context. What continues to make these policies different from pension annuities is that every single one of them is individually underwritten. It is bespoke for that person. So it absolutely takes into account that person's age. It completely takes into account everything that's on their medical records, what medication they take. You know, the insurance companies that offer these policies, they'll contact collectively, just the once, they'll contact the care home maybe and do a telephone interview with the care team to get a really robust picture of what that person's health looks like. And so the annuity will be priced accordingly. If you like, crudely speaking, the insurance company is trying to predict how long they'll be paying out for, and they'll price the plan accordingly. Now, on some cases, they get it right. On some cases, they get it wrong. On some, they break even. And obviously, as an insurance company, collectively, they win. Otherwise, they wouldn't be in the business. But you as a family, you don't know whether you're the one case that, you know, you might make quite a lot on. People don't generally buy this with that in mind. They're buying these to take away the sort of worry of the money running out and just to have some peace of mind. But you've got one pot of money when you're a family. And as I say, pay as you go carries its own type of risk. If the person lives a long time, all the money could be gone, and then what? Equally, you buy one of these and spend a big chunk of money on it, and the person doesn't live as long as the insurer predicted, the estate makes a loss. So that's why I do use the term gamble. It's a gamble around somebody's life expectancy. Not all families want to take the gamble, and that's fine, but it's even knowing that you have this as an option that, to me, is the problem. So here at Eldercare, we sort of act as an intermediary. It's not our product. We take the information from the family, then we go out to the marketplace and we get all the quotes. And then we write a report that is in plain English. We've been writing these for 20 years. So pretty much any question you can think of is going to be answered in that report. So is it portable? Can I move from home to home and take it with me? Yes. Thinking about things like fees going up, it will tell you whether there's an option to build in a fixed percentage increase and what it will cost, or whether you link it to inflation, what the cost of that would be, etc. And it also covers off, and acknowledges that a family might be worried about losing a big sum of money if mum or dad dies early. So we do also look at how best you can protect the capital. It might be by including some life cover. That does put the cost up, or it can be done by delaying the start date of the policy, a bit like having a voluntary excess on your car insurance. You give the insurance company less money, so you're risking less. They don't start paying out straight away, but they do still cover from the beginning of year 2 or beginning of year 3 for life. So you've still got the longevity protection, but you're simply not risking as much money, giving as much to the insurer in the first place. Our job is to make sure all of this is fully understandable in, as I say, plain English and clearly balanced descriptions, if you like, in the report. We also accept in this current day and age that it would be very valid to wonder or worry about what might happen to the insurance company if it went bust. These policies are protected by the Financial Services Compensation Scheme, the money that covers you at bank, but there's no cut-off. So it's 100% of your income that's protected till the person dies, or sorry, the income of the policyholder. You can probably see why people might do this. Well, the appeal of it is if it protects the remaining funds, so you spend X to protect Y. It also just avoids that scenario of applying for local authority funding, whereby most of the money's gone and then you're at the whim of the council as to whether they will or won't pay and to whom they will pay and how much. So it removes that. Also, some people that are quite wealthy might buy these policies simply to save inheritance tax, because it reduces the value of the estate immediately. Sometimes people can buy these and not need them anymore. That's unusual, but the common occasion might be if somebody qualified for that NHS funding that I mentioned earlier. In that scenario, they no longer need the annuity, or the annuity just pays to them into their own bank account rather than to the care home. So you do genuinely get the income for life. Here at Eldercare, because we understand that this is often an alien concept, nobody understands it, knows about it. How do they know if they want one until they've got the facts and the figures in front of them? If I tell you it's going to cost you £1,000 to get some quotes, I suggest for many it will put you off. So we've made that decision because we've got the low cost sort of remote model. We can get you those quotes, do all the research, give you the advice, expert advice, free of charge, but we do levy a fee built into the cost of the policy, a bit like old style commission, but you can't call it that anymore, and it's an equal fee no matter who the insurer. So it's perfectly obvious why we're recommending one insurer. It's because they're the cheapest. We'll just be paid a fee if a purchase is made. So I think that's transparent. I think that suits most clients who aren't sure about this, rather than committing to a financial payment when they may not actually want to go through with it. These are the insurance companies that offer these policies, just so you're aware, really, but you can't go direct to them. So you have to go through an intermediary, such as ourselves, because whilst the product's not that complicated, what if mum should be getting NHS funding? What if state support is going to be around the corner. You shouldn't be spending money without understanding all the other options, and you need a specialist to give you the advice around that. As I say, there's very, very few advisors, if any others, that just do exclusively this. Because we do exclusively this, we've got very good relations with all of these insurers. So if there's any haggling that we could do on the price, we'll do it. If there's any nuances that you need to be aware of, differences between these policies, we'll make you aware of it. Don't be going to different brokers to get the quotes, because all brokers are going to go to these four. Do your due diligence on the experience of the advisor before they go out and get the quotes for you. So if you're talking to an advisor that gets 1 or 2 of these quotes a month, you know, we're requesting 1 or 2 a day. So you've got to make sure they've got that experience. And I strongly recommend you seek out the customer reviews on Trustpilot. Trustpilot, everyone knows of. Most people have got a Trustpilot profile. You go on and look at ours, Eldercare Solutions, on Trustpilot, and you'll see at least 60 or 70 reviews in the last year or so from our customers. Have a read and compare to anyone else that you're thinking of using. That's our final slide, just so that you've got the contact details there with a helpline number, office hours, email address for any other random times, or if you just want to give a synopsis of your situation, put your questions in writing. I've landed specifically on this care fees annuity page because it's got a ready reckoner, a calculator that you may find helpful. All you need to do is put in the age of the individual, cost of the care, and roughly how much income they already have to put towards the fees, and it will give you an estimated cost estimate based on quotes we've obtained for people of the same age. So it's an average. Some people in there will be more poorly than your loved one or less poorly. So of course it will change on underwriting. But I think if you haven't got a clue what one would cost, it's a good starting point to sort of give you that parameter. We'll try and keep the news section up to date around, you know, is the care cap going to be postponed again once we get nearer to 2025 and so on. But I think for most people, we can just push that really to the side for now and look at what we talked about today, which is any eligibility to state support, understanding what that is, whether there's ever going to be eligibility for NHS support and what that might look like, and then really how you can sort of opt out of the system yourself and make provision, guarantees, build that peace of mind in for the family via potentially a care fee annuity product. So hopefully